Derek just got a $10,000 raise. He took home less money that month than the month before. He checked his pay stub 3 times. The math was correct. And the reason this happened is something your employer, your HR department, and most financial advisors have never fully explained to you. Let's run the real math. Let's set this up properly. Derek earns $85,000 a year. He just received a $10,000 raise, bringing him to $95,000. He is thrilled. His family is proud. He goes out to dinner to celebrate. 2 weeks later, his first paycheck at the new salary arrives. He opens it expecting to feel the difference. He does not feel what he expected. Here is what most people fundamentally misunderstand about how income taxes work in America. Most people believe that if you move into a higher tax bracket, your entire income gets taxed at the new higher rate. This is completely wrong, and this single misunderstanding causes millions of people to make financially irrational decisions every year. They turn down raises. They avoid overtime. They decline bonuses, all because they believe earning more money will somehow cost them money overall. That specific fear, the idea that a raise can make you poorer, is based on a misreading of how the tax bracket system actually works. Here is how it actually works. The United States uses a marginal tax rate system. Marginal means the rate only applies to the income within that specific bracket, not to your total income, not to every dollar you earn, only to the dollars that fall within that bracket range. Let's use round numbers to make this clear. In a simplified marginal tax system, imagine 4 brackets. Income from $0 to $44,000 is taxed at 12%. Income from $44,000 to $95,000 is taxed at 22%. Income from $95,000 to $201,000 is taxed at 24%. Income above $201,000 is taxed at 32%. Derek earned $85,000 last year. His taxes were calculated like this. The first $44,000 was taxed at 12%. That is $5,280. The remaining $41,000 was taxed at 22%. That is $9,020. His total federal tax bill was approximately $14,300. His effective tax rate, the percentage of his total income that went to taxes, was about 16.8%, not 22%, even though he was in the 22% bracket. Because only part of his income was taxed at 22%, now Derek earns $95,000. His taxes are calculated like this. The first $44,000 is still taxed at 12%, still $5,280. The next $51,000 is taxed at 22%. That is $11,220. His total federal tax bill is approximately $16,500. His effective tax rate is about 17.4%. He moved from 16.8% to 17.4% effective rate, not from 16.8% to 22%, not from 16.8% to 24%. Just a 0.6% increase in effective rate on his total income. His $10,000 raise generated approximately $2,200 in additional federal taxes. He keeps roughly $7,800 of that $10,000 raise after federal taxes. He is not poorer. He is $7,800 richer per year. The raise was always worth taking. So if the bracket math works this cleanly, why did Derek feel like he took home less? Because marginal federal income tax is only one piece of the picture, and it is the piece most people actually understand correctly once explained. The pieces that create real confusion and real financial pain are the ones nobody talks about at the dinner table. Here is where the tax bracket trap actually lives, not in misunderstanding marginal rates. In the hidden cliffs that exist alongside the bracket system, cliff number 1. The student loan interest deduction phases out between $70,000 and $85,000 of modified adjusted gross income. Below $70,000, you can deduct up to $2,500 in student loan interest. Above $85,000, you can deduct nothing. If Derek was at $83,000 last year and his raise pushed him to $95,000, he just lost a $2,500 deduction. That is $2,500 of income. He now pays full taxes on that he did not before. His raise cost him roughly $550 in additional taxes just from this one deduction disappearing. Cliff number 2. The child tax credit phases out starting at $200,000 for single filers. But other credits and deductions phase out at much lower income levels. The earned income tax credit phases out between $17,000 and $57,000 depending on family size. If Derek has children and was near the edge of an EITC phase-out, a raise can reduce or eliminate thousands of dollars in credits. A $10,000 raise can trigger a $3,000 to $5,000 reduction in tax credits depending on the specific situation. That is not the raise costing him money, but it is the raise producing far less net benefit than the gross number suggested. Cliff number 3. Health insurance subsidies through the ACA marketplace phase out sharply at 400% of the federal poverty level. For a family of 4, that threshold is roughly $120,000. A raise that pushes a family over that line can eliminate thousands of dollars in annual premium subsidies. In extreme cases, a $1,000 raise can cost a family $5,000 in lost subsidies. This is a real cliff. It is not theoretical. And it is the most dramatic example of a raise genuinely producing a net negative financial outcome. Cliff number 4. Social Security benefits become taxable when combined income exceeds $25,000 for single filers and $32,000 for married couples. At $34,000 for a single filer, up to 50% of Social Security benefits become taxable. At $44,000, up to 85% becomes taxable. A retiree receiving Social Security who takes on part-time work and pushes their combined income over these thresholds can trigger significant additional tax on income they previously paid no tax on. The raise from part-time work can cost them more in Social Security taxes than the raise itself is worth. Cliff number 5. Medicare premiums are means tested through a system called IRMA, Income Adjusted Monthly Adjustment Amounts. If your income exceeds certain thresholds, starting at $97,000 for individuals, your Medicare Part B and Part D premiums increase significantly. A $5,000 raise that pushes a retiree over the $97,000 threshold can increase their Medicare premiums by $816 to $3,000 per year, permanently, until their income drops back below the threshold. This is a raise that genuinely and mathematically costs money. So let's go back to Derek. His raise was from $85,000 to $95,000. The marginal tax on that $10,000 at 22% cost him $2,200. He loses his student loan interest deduction worth $2,500 in income, costing another $550 at his marginal rate. His total additional tax burden from the $10,000 raise is approximately $2,750. He keeps roughly $7,250 of the $10,000 raise. He is not poorer, but his raise felt like $10,000 and delivered $7,250. The gap between expectation and reality made it feel like the raise cost him something. It did not cost him money. It cost him the illusion of what the raise was worth. Here is how smart people navigate this. Step 1. Understand your effective tax rate versus your marginal rate. Your effective rate is what you actually pay. Your marginal rate is only what the next dollar of income costs you. These are very different numbers. Never make a financial decision based on your marginal rate alone. Step 2. Know where your income stands relative to the phase-out cliffs. Before accepting a raise, ask your HR department for the new gross figure. Then model the impact on any credits or deductions you currently receive. A 10-minute calculation can tell you exactly what the raise is actually worth. Step 3. Use tax-advantaged accounts to manage your taxable income. A $10,000 raise combined with a $10,000 increase in 401k contributions can keep your taxable income exactly where it was. You get the raise. You avoid the bracket creep. You build retirement wealth simultaneously. This is not tax evasion. This is the tax code working exactly as designed. Step 4. If you are near an ACA subsidy cliff, model the full impact before making income decisions. Sometimes taking on less income, fewer hours, deferred compensation, increased retirement contributions produces a better net financial outcome than maximizing gross income. This is counterintuitive. It is also mathematically correct in specific situations. Derek's raise was always worth taking. Every raise is always worth taking at the marginal tax level. The confusion about taxes costing you a raise is almost always based on misunderstanding marginal rates. The genuine cases where a raise produces a net negative outcome are specific, identifiable, and solvable with proper tax planning. The financial advice machine loves to oversimplify both sides of this. Some people say taxes never matter and you should always maximize income. Others say the tax system is designed to punish success. Both are wrong. The tax system is a set of rules with specific thresholds that reward people who understand them and penalize people who do not. Understanding which cliff you are near and what tools you have to manage your position is not optional financial knowledge. It is the difference between a raise that feels good and a raise that actually is good. So the next time you hear someone say they turned down a raise because it would put them in a higher tax bracket, ask them one question. Do you know the difference between your marginal rate and your effective rate? Because the answer to that question determines whether they made a rational financial decision or an expensive one based on a misunderstanding that cost them real money.